I'm increasing and I'm upsizing and I'm optimizing the narrative for a little bit because you and I did rein it in today, Patrick, and as you know, I'm a little bit on a bender right now. I'm a little spunky today, so this ought to be very interesting. Just so everybody knows, it's that's kind of where I'm at right now, and the good news is that typically produces some pretty good content. So
It's
it's going
fired
to be
up. It's fired up
super.
Francoeur. It's fired up Francoeur, not fired up Francie. I think that we transferred that nickname over there, and we go.
That's a good idea. All right, well, let's get into it. For those of you that don't know me, I think I know just about everybody here, but maybe somebody's listening to this and they haven't met me before on recording. My name is JG Francoeur. I'm the CEO of Visture Property Group, and I've worked with the Real Estate Investment Network now for many years. And I started out as just a member, a student, and did that for years, and have been able to grow a sizable portfolio. And we'll talk more about that, but what I'm going to really dive into today is kind of some nuts and bolts on cash flow, nuts and bolts on real estate. And I'm going to talk about timing. I'm going to bring you back to some fundamentals about real estate that you may have forgotten. So kind of strap in, get ready. I always put out these disclaimers these days, which is every project yields different results. The projects I show you here today are actual numbers, real results. Every project does yield different results. And I will talk about VIP consultations that we're doing at Visture now because we've had so many people call the office looking for help that we do these new VIP consultations. I'll talk about that towards the end. So just keep an eye out for that. And we can only do so many. They're quite limited on how many we can do because they're quite intensive. So in case somebody doesn't know, Visture Property Group is essentially a full stack, vertically integrated company. We started as a holding company, and we were just Visture Property Group. We just did holds. We owned real estate in Ontario. We expanded to Alberta. Then we got into the property management game about 10 years ago. And now we serve hundreds and hundreds and hundreds of clients in Peterborough, Lindsay, Aurelia, Barrie, and Oshawa. Those are our markets. And then we've since then increased and gone into Visture Property Construction. And we recently actually acquired a drywall company. Patrick, I don't even know if I told you that, but yeah, we acquired a drywall company here in Peterborough. So we continue to grow, and now Visture manages essentially over $90 million of real estate. We're getting pretty darn close to 100 million. If not, we're right there. So Visture's grown a lot, and it all started with one property, one vision, one idea, and we continue to grow Visture Property Group. So a bit about the company, give you a bit of my background if in case some of you don't know my background. Now, everyone that has seen me speak before, this has been my bender now for probably a solid 2.5 years. I came up with this out of frustration one day. Patrick and I were on stage somewhere, and people were just yelling in 2022, "I can't find cash flow. I can't find cash flow. I can't find cash flow." And I just said, "Guys, cash flow isn't found. Cash flow is created." And since then, I've been speaking about this concept of how do you create cash flow. And I've talked about secondary suites before. I've talked about coach homes before. I've talked about development before, and I continue to show people how to create cash flow. Well, now here comes the expanded narrative for this particular talk. I believe that everybody is sitting on gold. Actually, I took this picture from Patrick's vault because Patrick sleeps with his gold at night, as you guys probably many of you know. But I think every single one of us real estate investors, even if you have even if as an investor, you only have one property and it is your single family home, you are sitting on gold. And I'm going to show you that tonight of how you're sitting on gold and how, without acquiring any more properties, you could actually build your financial future in a very considerable way by minimizing the risk of your real estate, maximizing the rewards of your real estate, and really turn your current assets into more gold. So that's kind of the expanded narrative for tonight. And I want to start, and here comes the spunkiness, because Patrick and I have been speaking on this. We did a show, Rein It In, today. And I think this is such a critical slide, which is there's no wrong economy for investing in real estate. There's just the wrong tactic in the wrong market at the wrong time. So there's three parts there: tactic, market, time, which I'll speak to all three tonight. But let's get this straight. I'm kind of going back to my roots here, back in the day in 2012 when I was listening to George Doobie, he was around back then too, by the way, folks. I was listening to George and listening to Patrick and listening to Don Campbell and listening to all the others, Jared and all the others on the stage. And one of the points that was driven home in 2012, and if I bring you back to 2012, keep in mind this was just post great financial recession. Real estate was still in the dumps in 2012, 2010, 2011, 2012. Real estate was still in the dumps. And we were very much kind of there where we are now, which is it definitely was not favorable. And the message that was sent back then, and it'll always be in my mind, is real estate works, period. Like, you can't blame real estate. You could blame you picked the wrong tactic. You can pick that you can blame that you picked the wrong market. Maybe your timing wasn't great, but you can't say that real estate doesn't work. And that's the bottom line. And I think as investors, wherever you are in Canada or in the world, and you're listening to this, I think that you need to be anchored in that belief right now, which is real estate works, period. And especially if you have the right timeline, you can rest assured that real estate will work for you. And if we really break down what real estate is, and this is the thing that I love most about real estate, this is why I did a podcast actually. This is called the podcast is called the Happy Accidents Podcast. Actually, Patrick, I got to get you on that podcast. It's called the Happy Accidents Podcast. And on that podcast, I revealed for the first time ever, I don't think I've ever said it here in this particular room, but I used to hate real estate. That's true, by the way. Like, I used to be anti-real estate. Up until 2010, I was anti-real estate. I thought there was better ways to allocate your money. I thought there was better places to put your money to work. I did not think real estate was the right move. And what changed for me in 2010, 2011, 2012, as I studied, and I'm going to take you back to those days, is I realized that if done right, real estate is essentially just like a wave. And you could see that wave coming. And if you sat at the ocean, and I'm sure all of you have traveled extensively, and you're sitting there on the beach, sipping your coffee in the morning, and you just see a wave, and then you see another wave, and then you see another wave. And pretty soon it's kind of very rhythmic. And very soon you're kind of like, oh, I can predict these waves are coming. Oh, look, every fifth wave is a bigger one. Oh, look at that. Every second after the fifth wave is actually a little smaller. You can kind of start to predict the size of these waves and so on and so forth. This is exactly how real estate is if you know what you're looking for. Now, here's where I anchor you, and I don't want to bore you, but I had to bring it back to this. And I had to give a shout out, obviously. And I know, Patrick, right? You're laughing, but I had to bring it back to this because I think people are just going to be have to be anchored in these fundamentals, which is you can see these waves coming. How do you see these waves coming? I thought there might be a couple newbies here listening to this, so I thought I would put it out there. This is the long-term real estate success formula, which all of you should know by heart. Like, this should be tattooed in your minds. I know it is for me. And when you invest in the proper markets that have growing GDP, growing employment, growing population, it will yield, the demand for rentals will grow, vacancies will go down, rents will go up, property demand will go up, and prices will go up. Meanwhile, if you invest in real estate markets that have shrinking GDP, growing unemployment, meaning shrinking employment, and population decline, then the rest ensues and you have decreasing property prices, right? These are the fundamentals, not the news, not the variety of influencers that are out there. And many of us have been through these influences over the years, from COVID to interest rates to now a new tariff war and all the other shit that's going to come after that. Point is, those are just influencers. Those are not the fundamentals. Now, that's only the first part of the equation. The second part of the equation is the cycle. Now, as part of a real estate market cycle, we know that we go from boom to slump to recovery. Now, where do you think we are in the market right now? Put it in the chat. Do you think we're in a boom? Do you think we're in a slump? Do you think we're in recovery? What do you think? Put it in the chat. We do know that after the boom comes the slump. After the slump comes the recovery. We do not know how long we're going to be in a particular area for. We don't know how long we're going to be in a boom. We don't know how long we're going to be in a slump. We just know that after the boom comes the slump, and after the slump comes the recovery. And the fundamentals tell us, and as well as all the other 40 different factors that RAIN researches, tells you where you are. Well, a lot of people think we're in a slump right now. some people think beginning, some people think the middle, some people think the end, some people think we're in the middle of the recovery. The answer is it depends on where you are in the country, because more than ever, the country, if you're in Calgary, Alberta, it's very different than if you're in Peterborough, Ontario, which is very different than if you're in London, Ontario, or in Kitchener-Waterloo like George, or in BC like Patrick. It just depends, and you have to look at your particular area. And then based on that tactic, you can then choose the optimal, based on the market, where you are in the market cycle, you can then choose the proper tactic that has the most probability of working. And if you do that effectively, ladies and gentlemen, if you do that effectively, you will see the waves coming. So I don't know the last time when you guys ran these numbers for yourselves or when you looked at your particular market, but that is something that I encourage all of you to be anchored in that. Don't get anchored to the YouTube shows and the bullshit on the news and all the various other stuff. Be anchored in your data. Make data-driven decisions, and that's the data you all should be tracking for yourselves. But I'm not here to give a sermon about real estate investing tonight. I'm here to tell you what the next wave is and what's coming down the pipeline from my perspective. And Patrick and I, and it's not like, I think one of the best things is that pretty much everything we say is always recorded. It's always on YouTube. It's all over the place. And as a result of this, we're either right or we're wrong. And let me tell you, when Patrick's wrong, as you know, I tell him. And when he's right, I also tell him. So, but we've been talking about this particular supply crunch coming for a while, which is we are going to have a pretty significant, what we think, single family supply crunch coming down the pipeline. We've been talking about this for probably 18 months, and this is only going to get worse. You can see from this chart, as well as this particular chart, which is awesome, that single family dwellings and the housing starts of those dwellings is just going down and down and down and down and down, almost to the point where they're non-existent. Now, in general, construction, as you can see, is quite elevated right now, but most of it is in the apartment segment. Most of it is in multifamily. And that's fantastic for those people. But what we're seeing is, and that this, by the way, sorry, a little bit of an aside, this is why sometimes on Rein It In, the show we do, which you all should be watching and commenting and liking and all that stuff. I hope you are. But we always talk about how some markets are going to have softer rents into the future. That's because look at all this apartment supply that's going to hit the market. That will have an impact on rents. Okay. But look at that dark blue line. It's getting smaller and smaller and smaller and smaller and smaller. And so we see a single family supply crunch coming. Now, how do we define single family? That means a single family freehold apartment. That means maybe a duplex. That means maybe a triplex. Anything less than 4 or 5 units or less is essentially falls under the single family umbrella, just in case you don't know. So this is the next wave that's coming. Question is, how can you take advantage of it? And I'm going to show you now some things that we're doing and some projects that I'm working on in order to take advantage of this wave. You guys know I put my money where my mouth is. I'm just being transparent with what I'm doing, but I am seeing this wave coming, and as a result, I'm working on it. So this is what we call the Visture Intensification program. This is about taking a single title, a piece of land, and essentially intensifying it as much as you can in order to capitalize on this emerging single family housing crisis. Very, very soon, you're going to start hearing this in the news: single housing family crisis, single family housing crisis. There's not enough single families, and so on and so forth. You're going to start seeing this. You just wait for it. So let me take you back to July 2023. So here we are, July 2023. Visture acquires this property here. And at the time, my analysis showed that we were cresting, and we were essentially, and I'm just going to show you this. Okay. My analysis was showing me that we were essentially towards the end of the slump in my particular market where this acquisition was done. And that's where I thought in July of 2023, that's where I thought we were. By the way, the interest rates at this point were on their way up, but they weren't cranked up to the nth degree as they got to. So what I did is we purchased this property. This was an older building built in the 50s. And as you can see, big, beautiful bungalow. It's actually quite a sizable building. This thing's like, shoot, I think almost 3,000 square feet, 1,250 on the bottom, 1,250 on the top. The garage is an extra 500. So it's essentially a 3,000 square foot building, including the garage. And as you can see from these pictures, it wasn't good. I mean, this thing was destroyed. This was owned by an old Italian family, actually an Italian estate. It was a private deal. I think we purchased it and we got a pretty good entry price, but we got in there, we started sketching, we started destroying, we started gutting, and we ended up gutting just about essentially the whole thing. And look at the back. I mean, the thing was falling apart. The only good thing they had was they had just replaced the liner on the pool. That was the big sales pitch. Don't worry, we just replaced the liner on the pool. So as you can see, this thing was in pretty rough shape, and I'll spare you the details of everything we did, but I'll show you a couple of the after pictures. Look at this thing. I mean, stunning, absolutely stunning. Redid everything, custom kitchen, granite countertops. I mean, absolutely beautiful. You can see it was staged really, really well. And look at that backyard. That backyard is so deep, you could barely see the end of it here, right? So here's the moral of this story. It was very interesting because my plan was to do a fix and flip on this, because I thought, and if I fast forward, if I go back to this slide here, keep in mind, right? I thought we were here. I thought we were here at the end of the slump, and I thought we would rocket through the recovery. That's what I thought was going to happen. I made an assessment of where I thought it was going, and I thought if we can rocket through, we were going to be in a good spot to flip this thing. And I got it for quite a very good entry price. So I was in good shape. Well, I put it on the market. My assessment wasn't wrong, wasn't right, because the influencer of an interest rate, they jacked it. They went crazy between July and November on interest rates. They went absolutely parabolic, and that definitely brought the market back into slump. So it didn't accelerate like I thought. It went back. So now I'm sitting on something that is losing me money every single month. But I'm thinking, wait a second. No, no, no. I'm actually sitting on gold here. I'm not sitting on a money losing asset. I'm actually sitting on gold. I just have to look at it differently. And this is what I think a lot of investors have to start wrapping their minds around. You may have a property that is either cash flow negative right now, or you can't quite get it to cash flow, or it needs some work, whatever the case may be. But if you're looking at a particular piece of property, you're thinking this thing is losing me money, I urge you to consider, how is this sitting on gold? Because I'm telling you, it's there. You just got to find it. So once I got thinking about it, and once I put it through our intensification program and said, okay, let's look at this thing. Well, I figured out that this was actually a 30,000 square foot lot. This was a huge lot. It's like 110 wide by, I think, 250 or 300, I think 300 deep. It's a huge lot. And as you can see from the positioning there, 1719, that's our property. It's a really nice lot. It's right at the end of a cul-de-sac, which is beautiful. We've got no neighbors on the one side. It's a stunning, stunning area. So this is what I thought. This was our finished product when we were done. We did a nice layer of stone at the bottom, as you can see. Turned out really, really well. Here's the game plan with this one here. I'm going to show you how it goes from a money losing asset to an absolute cash cow producing gold bars on a monthly basis. First things first, we're going to separate the garage. Now, here's the garage when we bought it. Okay. This garage is 524 square feet. That makes a beautiful, let me say that again, a beautiful 1-bedroom apartment. So I'm going to take this single family home. I'm going to cut off that garage. And when I say cut off, I just mean from the inside, not the outside. Like I'm not detaching it, but from the inside, I'm going to cut it, and I'm going to build, we're building this out into an apartment. I'll show you the finances and the numbers on it in a second. Then you have the basement. As you saw, we did a fantastic job renovating this thing, and it's going to take very little in order to separate it right there. So we're going to have an upper unit. We're going to have a lower unit. We're going to have a garage unit. We're not done yet. We are now going to do a coach home on top of there at the back of that. So can you count those units for me? That's 1 for the upper, 2 for the lower, 3 for the garage, and 4 for the coach homes. Now I know what you're saying. You're thinking, JG, I thought you told me we can only have up to 3 units. That's what Bill 23 says. I thought it was only 3 units. Well, you're right, my friends. But I also told you, and I've been yelling it from the rooftops, that most of the municipalities are pushing this, and they're going to 4 units, and some of them are going to 5 and 6 units. Hamilton did it. Vancouver's done it. Various municipalities have done it in different ways. Well, Peterborough is pushing to 4 units. So we're going to be able to do this. And here's how the numbers shake out in this particular example. So right now we're sitting, and I'm just, let me walk you through this. Can you see my cursor here, Annie, on the screen? Yes. So as I didn't even put the numbers as a single family home, because if I showed them to you, it'd be friggin' depressing. I think I'm losing like $1,500 a month, something like that. It's depressing. So now, so if I make it just a duplex, and we've often talked about this, and for those of you that have listened to various trainings we've done over the years, we always talk about multiple exit options, right? Well, when we do our numbers, we always do them in sequence, meaning we say, okay, if we did a duplex, here's what it looks like. If we do a triplex, here's what it looks like. If we do a triplex plus coach home, here's what it looks like. Because we might exit at any one of those points. We may not wait till the end, right? Depends what happens. Depends what happens to the market. So in this particular case, as a duplex, right now I have 715 grand into this thing, which is a whack load of dough. I'm going to need to invest another $50,000 into it in order to get the whole thing legalized as a proper duplex the way I want it. And that will essentially, I'll have 765 into it. That should appraise for 825. Once I get my financing, I'm left with about 146 grand into the deal. Now the rental income and then mortgage payments and taxes and insurance and property management and maintenance and so on and so forth, I'm cash flow positive $46. Yahoo! Let's do a dance, right? Let's celebrate for $46. I don't think so. I'm not doing all this work for $46. No friggin' way. So let's keep going. Once we do the garage, that makes it a triplex, right? 3 units. Now, by the way, what's happening? Okay, sorry, I wasn't gonna get into this, but now I gotta get into this. So I call it a triplex, but it's not legally a triplex. It's legally the way they're doing it in most municipalities, because if you call it a triplex, you'd have to get a zoning amendment. By the way, don't let me go off on a tangent, but I'll go off on a tangent to the tangent, which is Peterborough just doubled the freaking fees, Patrick, doubled the fees for a zoning bylaw amendment, doubled them. No, sorry, more than doubled them. They took them from $4,200 to $14,000. How ridiculous. And people say, oh, yeah, they're trying to solve the housing crisis. Bullshit. They're not trying. But this is a good thing because this will secure your future financial investment. So don't worry too much about that. But here's my point. These are actually single family plus ARU plus ARU plus ADU. Legally, that's how it's organized. That is different legally than a triplex. Okay, for those of you that know what I'm talking about, fantastic. That's good knowledge for you. If you have no idea what I just said, like, JG, are you speaking Chinese to me right now? That's okay. Don't worry about it. It's not really that relevant. So as a triplex, look at these numbers. So if you go from a duplex to a triplex, take this 765, put it up here. It's going to cost me 125 grand to build out that garage. You got to add the plumbing. You got to add the sewer system. You got to connect that sewer system. You got to do kitchen, bathroom. It's going to be 520 square foot, 1 bedroom. It's going to be beautiful. 125 grand to convert that garage. I'm into it for 890. That will appraise for about $1,050,000. I'm going to finance 787. Now look what's happening. I'm into it for 102,000. I've actually decreased my amount of cash in the deal, which is fantastic. And I've increased my rents from $4,200 to $6,000 on all 3 units. And I'm cash flowing now $645 a month. Now we're starting to talk. Don't forget, these interest rates are still pretty high. As the interest rates come back down and I lock in, this number goes up. So we're getting there. Now, as I add the coach home, that 890 goes up here. Cost me 265 grand to build a coach home on top of this. That means I got 1.155 million into it. It's going to appraise for about 1.325 million. I'm going to finance 993. I'm into it for $161,000. Folks, look at this. You got an asset worth north of $1.3 million, and you only got $161,000 into it. What is that percentage ratio? That's like, what does that? Do the math for me. 11%, 12%? Like that's your down payment essentially? It's incredible. The rents go up to 84.50 per month. And total cash flow now, I've taken this is 1634 per month, which is a 12.16% cash on cash return. And I'm appreciating $66,000 per year, which is incredible. So this is why I'm saying everyone's sitting on cash. Everyone is sitting on absolute gold mines in their properties, whether they own a single family with an empty backyard or whether they have a duplex, they can add a coach home, whatever the case may be. But what's happening is if you buy the right properties today, and this is the huge opportunity for those of you that are able to acquire properties right now because you have some dry powder, if you buy the right properties today, you're going to be able to convert a single family to 4 units, if not more. And that's what we're doing. And as you can see, the growth there is absolutely phenomenal. And this does 3 things at the same time. 1, it grows your income. 2, it grows your asset in an incredible way. 3, it lowers your risk in a big, big way. Like instead of having one single income on that property, now we have 4 incomes on that property. We're generating 84.50 per month in income, which is incredible, and net positive cash flow of 1634. It's really great. So it does a lot of things all at once. So this is actually working. Oh, Kicks, good question. Explain the cash in line where it went from 146 to 102. So this is essentially the amount of cash I have in the deal, right? A big thing that everyone's, always worried about is how much money do I have to leave in this deal? And the answer is 146, 250. Like right now, I probably have about 250 in this deal. I got a lot in this deal. And when I refinance for the duplex, I'm going to be able to take some of that cash out. And then when I refinance for the triplex, I'm going to be able to take more of that cash out. And then on the final triplex, I'm going to have to put a bit more cash back in, but that's still fantastic. You only had to invest 161,000 of your own money to get a $1.3 million asset. Does that help, Kicks? So this is what this is all about. This is the gold bars I believe everybody's sitting on. So we're doing it again. Look at this little gem right here. Look at it, Patrick. This is my latest acquisition. Closes next week. How do you like this gem right here? So this is right now, this is an illegal 2-unit. The reason it's illegal is because it's been separated into 2 units, but it's not legalized. The city does not recognize this as a 2-unit. Now, you guys remember, I told you never do this. Why? Because you're not going to get your value out of it. And that's exactly what happened here. This guy did all this work, didn't do it legal, tried to get it refinanced. What happened? Keith will tell you, every mortgage broker will tell you, they didn't get their appraisal, they didn't get their money out of it, and then he's running out of cash. Well, JG, the savior, came along. So I helped him get out of this deal, and I'm going to have to legalize it properly. But I'm going to go further than that. And this, you'll see another deal. I have so many deals right now, so many projects on the go. There's others I want to show you, but I don't have time today. But this one here, I'm going to keep you guys in the loop on this as I go through. And if you keep an eye on our social media channels, I'm doing videos almost 2-3 times a week right now on all the renovations we got going on and sharing pro tips on all the things we're doing. So take a look at that. But so this one here, what we're going to do is we're going to separate upper and lower like we always do. So the upper is going to be a 2-bedroom, 1-bathroom apartment. The lower is going to be a 3-bedroom, 1-bathroom apartment. But check it out, check it out, check it out. Look at that backyard. Oh, I love to see that backyard. Don't you see gold bars there? Like when I got to this property, I just saw like a mountain of gold bars back there. That's what I see anyways. I don't know what you're seeing, but that's what I see. This yard, again, look how deep it is. You can barely see the end of it. But look at this little beautiful thing right here. There's an addition on the back of this guy. And what we're going to do is we're going to drop that white, broken piece of crap addition. We're going to drop that and we're going to build a new addition. So we're going to do the upper unit, the lower unit. We're going to build an addition for the 3rd unit. Then we're going to build the coach home for the 4th unit. Okay. And here is the numbers. I will spare you the details, but you can pretty much see what it all happens, right? The numbers always pretty much shake out to the same, which is if you got a 4 unit in my market, both those deals were in Peterborough. Um, in my market, a 4 unit will appraise for roughly 1.3, a 2 unit, a 3 unit, like two duplex plus coach home, that'll appraise for 1.1, 1.2 million. A 4 unit like this would appraise for 1.3 million, roughly, give or take. And as you can see, the cash flow goes to about $1,600, per month. So it's a pretty incredible jump in value. And I think that, this is possible for everybody. This isn't like literally this here. This was another private deal. But I scooped it before it went to market. It was going to go to market, but there is no doubt that every single one of you drive by properties like this, just like this, every single day. These are not special properties. There's nothing special about them. What is special is the foresight to be able to take it from one, and having the right team is obviously really critical. And I've done lots of videos on what you need to do this kind of thing, but this is the importance of this thing. So the pro tip for all of this, I'm going to show you one final thing here as I go to wrap up. I got probably, what do I got here, Patrick? I got 5-6 slides left. The pro tip is the time is now for this. That's the most important thing I want to tell you, is the time is now for this opportunity. And the reason for that is because, let me go back to this. I'm going to show you a couple other slides, but I want to go back to this first. When we look at the market, okay, when is it, you guys all agreed, in general, most people think that we're somewhere in the slump, which is middle of the slump, end of the slump, and I would agree with that. And by the way, my personal opinion is I think that that we were going to lift ourselves out of that, and now this tariff war has definitely put a pause on that, and we're going to be sticking it out where we are for some time. But if you look at this, the best time, the optimal time to do buy and hold is at the end of a slump. And we all agree we're pretty much there. That is the best time to get into a buy and hold. We know that. That's for sure. 100%. Everybody will tell you that. If you have any experience in real estate, the best time to get in is at that point. Now, this strategy that this tactic that I'm going through here today, this intensification program, it combines two tactics. It combines buy and hold and fix, flip, and refi, or the BRRRR strategy, right? So is right now the best time to do a fix, flip, or refi, or a BRRRR? No, it's not. But you're not doing the BRRRR part right now. You're doing the BRRRR part later. You're acquiring now, but you're able to dictate when you refinance. And that's important. A lot of investors miss that point. See, what the thing is that we know that you're going to want to refinance these properties when you're in the boom. Beginning of the boom, middle of the boom, at the end of the boom, that's where you're going to get your best possible refinancing stage. And yes, we're not there today for sure, but you're not ready to refinance today either. It's going to take you some time to do all this work I talked about, right? So you have to look at it when you're looking at this particular intensification program I'm talking about, and this particular tactic, you're actually combining two tactics. So it's important to kind of look at it properly, because the good news is that you're able to control when you're going to refi. That's not the market. The market's not going to dictate to you when you refi. You're going to control that. You can go to refi right when it's time. And I know when it's time. It's going to be time when it's the boom. And you'll know when it's the boom because we'll tell you. All right. So the other reason I think that the time is now is these 6 points. Okay. First and foremost, if you're looking to acquire real estate, the entry price is very attractive right now, right? It wasn't long ago, guys, where you were bitching and moaning how expensive real estate was. Now you're bitching and moaning that it's gone down in price. My gosh, make up your mind. What do you want? Right? But the entry price is very attractive. Keep that in mind. Most of you can do this tactic on a property you already own without going and buying more real estate. So you're sitting on gold, and that's amazing. Second point to the right of that is construction costs are favorable. I can't emphasize this enough. I really cannot. construction costs right now are fantastic. We're doing stuff under budget. The last I 20, 30 projects I've done in the last couple months, most of them have come in under budget, not all, but most and many. So the construction costs are quite favorable right now. And I'm not saying it's cheap to build. That's not what I'm saying. I'm saying it's favorable because if you compare it to in a boom, let me tell you, the costs are very favorable to where they were in 2022 when shit was crazy. So right now, construction costs are quite favorable and the timing for construction is quite good. Appraisal are still strong. You need to have a good appraiser, but appraisals are still quite strong. So that's a good thing, right? That you need that. The fourth point on the right there is interest rates are declining. Just last week, they declined interest rates again. If you look at bond yields and where they've been going, they're down significantly from where they were 2 months ago. So interest rates are declining, and there's beginning. And if you talk to Keith and the other mortgage brokers that you all work with, there's some very favorable programs that are coming out. That's because the banks know they got to get this money to work. And as a result, they're coming out with these programs to get this money going, get this money lent out. So that's a good thing. The fifth thing, the bottom left, is multi-generational housing. I'm going to show you a chart on this shortly. And Patrick and I talked about this on the show today. He mentioned it a while ago. This is a huge trend, ladies and gentlemen. Multi-generational housing is a social phenomenon that's hit. It's another one of these waves. Remember, I talked about a wave at the beginning. It's one of these waves coming at us in this country. People want multi-generational housing, and these properties are perfect for it. Okay, so that's important. And the reason that's good, the reason that's a good thing is though that the properties that lend themselves to multi-generational housing will trade above market value in the future. That's what happens. When something is a hot commodity, it trades above market value. And I'll actually show you some charts on that in a second. And the last thing is that when you create income on a property like this, and the affordability issues have not gone away, they're there, they're still there, and they're going to be there forever. So my point is that any property that has income will trade above market value and outperform the rest of the market because it generates income for the owners. And don't forget, a lot of people, they might not want to do what I'm doing and rent all these units out. You, in your particular case, you might want to do that because many of you are investors, but somebody might want to buy this so they can live in one unit, rent out the 3 units, and not have a mortgage for the rest of their lives. That's not a bad thing either, right? So check out these charts, folks. Here's the price difference and the growth rates between single family homes and single family homes with accessory suites. I don't have it with coach homes yet because they're still too new, but look at this. From 2011 to 2015, a single family with accessory suite was worth almost $40,000 more than just a single family home. Then from 2016 to 2020, they were worth about $75,000 more. And then in 2021, it was $100,000 more. And now today, this graph would probably be more like $150,000. The point is that compounds for you over time because that's your asset and your value. So this plays in your favor in a huge way. The other thing, and this is just another chart to show you the difference, but what I want you to get from this chart is notice, and this is the part of this is the multi-generational housing phenomena. But notice how the blue bar is single family homes. The green bar is single family home with accessory suite, i.e. 2 units, i.e. duplex. Notice how the bars are getting, there's the discrepancy between the bars is getting bigger and bigger and bigger. So as time goes on, single family homes continue to appreciate the same way, but the green bar, the single family homes with accessory suite, it's outpacing that market. And you can see that in this graph. Very, very interesting. And then this is the last one I want to show you, which is this is the growth of multi-generational households in Canada from 2001 to 2021. That's all I could get data on, but it is accelerating, as you can see, and it's just going more and more and more. And there are millions. I think the last stat I saw a little earlier today was over 2.5 million multi-generational homes, and it's growing by, and I got actually a couple stats here. I wrote this down. Check this out. 2.1. So as of the 2021 census, 2021 census, there's 2.1 million Canadians living in multi-generational households, and that's a 50% increase from 2001 to 2021. It's the fastest growing household type in the country right now. Okay. And obviously, the key drivers of that are housing affordability, that cultural preference. That's a big deal. Cultural preference is a big deal. Elder care is a huge deal, and support for younger generations. So Patrick and I were talking about this today, which is you got those pesky kids, right? They have three choices. They're either going to rent, they're going to buy. We know they can't buy, they can't afford it. So they're either going to rent or they're going to stay at home. And a lot of them are choosing to stay at home. And that's developing these multi-generational households. So very, very interesting. In Ontario alone, multi-generational households grew 37.5%, so just under 40% between 2016 and 2021. So like I said, we've been talking a little bit about this trend. I got some data to show you guys, but I think this is going to be a really, really powerful trend going in the right direction. So that's why I say the time is now, because for the following reasons I just dictated. And that's why a lot of people are asking us at Visture to analyze their properties to see what we can do. We can't do all the requests that are coming in because it's just crazy. But we do these VIP consultations where we'll look at your property. Of course, you got to be in one of the markets we operate in. So if you're in Peterborough, Lindsay, Aurelia, Barrie, Oshawa, and surrounding areas, we could do that for you. You just let it know. We're doing it. We have a couple free ones that we do. We do sell them for $500, but we do a couple for free. Very, very limited on how many we can do. So if you're interested in that, text me. And I did have someone ask a question. Vanessa asked a great question, which is, would I recommend this in another province? And the answer is absolutely.